Over the past few months, the Malaysian Ringgit has been making headlines for one reason. It has been strengthening. Now, financial media, analysts, and regional economists have highlighted that the Malaysian Ringgit has gained momentum against several major currencies, supported by improving macro fundamentals, moderating inflation, and more stable global financial conditions. Headlines have been positive, but can also give a slightly misleading context about the Malaysian Ringgit, which I will explain later on in this video. First, what does a stronger Malaysian Ringgit mean? Allow me to give you an example. Now, when you say the Malaysian Ringgit is stronger, it means you need more units of another currency to buy the same amount of Malaysian Ringgit. Let's use the example of Singapore dollar versus the Malaysian Ringgit, usually called the Sing Ringgit exchange rate. Previously, Sing Ringgit was at 3.5. That means 1 Singapore dollar buys 3.5 Malaysian Ringgit. But recently, with a stronger ringgit, the Sing Ringgit is at 3.2, and that means 1 Singapore dollar buys only 3.2 ringgit. So assuming if someone wants to buy 1,000 Malaysian Ringgit, back then when the exchange rate was 3.5, 1,000 ringgit costs 285.7 Singapore dollars. But after the exchange rate fell to 3.2, 1,000 ringgit now costs 312.5 Singapore dollar. And as you can see, more Singapore dollar is needed to buy the same amount of Malaysian Ringgit. That's the simplest way to understand a stronger currency. And this applies across the board, whether it's the Japanese yen, the euro, the sterling pound, or the Chinese yuan. Foreigners now need more of their home currency to obtain the Malaysian Ringgit. Based on a couple of years of performance, the Malaysian Ringgit indeed has strengthened against several currencies, particularly those that are deemed to be strong. Most important is of course against the US dollar. 1 US dollar now buys 4.13 Malaysian Ringgit. Back in April, the figure was around 4.5. So overall, 1 US dollar now buys less Malaysian Ringgit compared to April. Against the sterling pound, Malaysian Ringgit has been strengthening since late April. And against the Japanese yen, the Malaysian Ringgit has been on a strengthening trend for even longer, since March 2020, which is of course largely due to the weakness of the Japanese yen. The euro started weakening since February 2024, rebounded in early 2025, but back on a weaker footing against the Malaysian Ringgit thereafter. Against the Chinese yuan, Malaysian Ringgit's strengthening trend also began around February 2024. And for Malaysians working in Singapore, they have been changing into less and less Malaysian Ringgit since March 2024. There is no single reason why a currency strengthens. It is usually a combination of economic, political, and global factors. But here are 4 possible drivers behind the recent strength of the Malaysian Ringgit. At first glance, interest rate differentials offer a partial explanation for the stronger Malaysian Ringgit. Malaysia's benchmark interest rate, called the overnight policy rate, or OPR in short, is at 2.75% and sits below the policy rates of the US and the UK, but remains above a few major economies such as the Eurozone and Japan. So based solely on these levels, the Malaysian Ringgit shouldn't be this strong. After all, higher yielding currencies like the USD and sterling typically attract more inflows. But this is where the second, more important point comes in. The FX markets care more about where interest rates are heading, not where they currently are. What's driving Malaysian Ringgit strength is the growing expectation that major economies will begin cutting rates, while Malaysia's OPR is expected to remain stable. This creates a narrowing forward rate differential. While other countries' yields are expected to fall, Malaysia's yield is expected to hold steady, and capital often flows towards currencies with stable or improving rate expectations. Malaysia benefits when global demand for key exports like semiconductors, palm oil, natural gas, and petroleum recovers. A stronger demand means more foreign buyers need to convert their currencies into Malaysian Ringgit to pay Malaysian exporters, and this drives the Malaysian Ringgit upward. Bank Negara Malaysia's foreign reserves provide confidence that the central bank can stabilize the currency if needed. Higher reserves are a positive signal to global markets and make Malaysian ringgit more resilient and attractive. Now let's be real. A stronger ringgit does feel good. Malaysians can buy imported goods more cheaply, travel costs drop, and the general sentiment improves. But economically, it's not always a blessing. Here are 3 cons of a stronger Malaysian ringgit. We need to know that Malaysia is an export-reliant economy. So when the Malaysian ringgit strengthens, Malaysian goods become more expensive for foreign buyers. Exporters earn fewer ringgit for the same amount of foreign currency. For example, if a company earns $1 million from exports, when the Malaysian ringgit is weak at 4.6, they receive 4.6 million ringgit. But when the Malaysian ringgit strengthens to 4.2 against the USD, they receive only 4.2 Malaysian ringgit. That's a loss of about 400,000 Malaysian ringgit, purely due to currency movement. So if profit margins shrink, companies may have to cut costs, affecting wages, hiring, and investment. So in an export-driven economy like Malaysia, currency strength can be a double-edged sword. Foreign investors are very sensitive to currency strength. If the Malaysian ringgit becomes too strong, Malaysia becomes relatively more expensive for multinational companies setting up factories or service centers. They might shift their investments to cheaper ASEAN countries like Vietnam or Indonesia. A stronger Malaysian ringgit also creates challenges for one of Malaysia's most important economic engines, tourism. Tourism is not a small industry in Malaysia. In 2023, Malaysia's tourism sector contributed around 7.4% of total GDP, making it one of the largest single contributors to the economy. Beyond direct spending on hotels and attractions, the sector supports transportation, food services, retail, local crafts, entertainment, and a wide ecosystem of small and medium businesses. But here's the problem. When the Malaysian ringgit strengthens, Malaysia becomes more expensive for foreign tourists. For example, imagine a tourist from Europe or Japan. Last year, €1 or 1,000 yen might have been able to buy them more ringgit and therefore more purchasing power while traveling in Malaysia. But with a stronger Malaysian ringgit, their currency now buys less. Hotels cost more, food costs more, tours will also cost more, and overall, Malaysia becomes a less budget-friendly destination. A stronger Malaysian ringgit does offer benefits, and here are 3 pros. A stronger Malaysian ringgit makes it cheaper for Malaysia to import goods denominated in foreign currencies. This lowers the cost of imported goods such as food products like milk, cheese, frozen meat and fruits, fuel and energy, especially since crude oil is priced in the USD, foreign cars, especially Japanese and European brands, electronics and gadgets like iPhones, laptops, TVs, industrial machinery, which helps Malaysian manufacturers reduce costs, and medical equipment like the MRI machines, ventilators, and diagnostic tools. Lower import costs help reduce inflation, making everyday life slightly more affordable. Since some portion of Malaysia's debt and obligations are denominated in foreign currencies, especially in the USD, a stronger Malaysian ringgit helps. The government can repay foreign loans more cheaply using less Malaysian ringgit. This in turn reduces pressure on national finances and frees up budget space for development spending. This is a meaningful macroeconomic benefit that doesn't overlap with cheaper imports or purchasing power. Last but not least, a strengthening currency signals economic stability, confidence in government policies, and investor optimism. These can attract long-term investors, support the stock market, and lower borrowing costs. In the world of foreign exchange, currencies never move in a straight line. They move in cycles, ups and downs, influenced by global conditions, domestic policies, and market confidence. The Malaysian ringgit has experienced a quick and noticeable strengthening recently, but these should be viewed in context. A short-term rebound does not erase the long-term trend of weakness. it is normal to expect some corrections and pullbacks after a period of rapid strengthening. However, as long as Malaysia continues to uphold the factors that support the Malaysian ringgit, such as stable fiscal policy, healthy trade performance, strong foreign reserves, and a predictable economic reform, the ringgit has potential to maintain a healthier trajectory in the long term. That's the end of my sharing. I will give updates to these crosses and names only when there are meaningful development, and in the next video, it will highly likely be on new crosses and new names. If you like what I'm doing, please help me out by giving me a like, please subscribe and hit the notification button for more videos like this.